All right, we are looking at very little change, but we swung to gains yesterday. 30 minutes until the start of the cash trade today. I'm Matt Miller. Dani Berger is on assignment. Bloomberg Open Interest starts right now. Coming up, AI and cost-cutting measures are allowing firms to eliminate more and more workers, with October layoffs hitting the highest level we've seen in 7 months. Caution over lofty tech valuations lingers. Qualcomm is the latest chip maker to deliver a bullish forecast that still fails to impress investors. And Disney signs DraftKings as ESPN's new sports betting partner, replacing a venture it had with Penn Entertainment. In terms of the stocks to watch this morning, Qualcomm is one of those that's falling in the pre-market, even though it beat expectations, and we're seeing that with a number of companies. Even if you put up a higher forecast, oftentimes you're not rewarded by investors. That's not the case with ARM. It has boosted its full-year forecast and also beat on the top and bottom lines. ARM shares up 3% in the pre-market. And Nvidia's CEO says China will win the AI race due to too many U.S. regulations and the Communist Party's subsidies for energy. We're also watching consumer stocks this morning. e.l.f. Beauty getting absolutely crushed, down 23%. DoorDash also down, but only decimated this morning. And Celsius Holdings falling 15%, all struggling as consumers spend less, at least in some segments. Turning back to this morning's, though, surprise data, U.S. companies announcing the most job cuts for any October in the last 2 decades as AI reshapes industries and cost-cutting accelerates. Mike McKee, Bloomberg's international economics and policy correspondent, is here at the desk. And Mike, I mean, if you just look at it in terms of the past few months, it's the worst number we've seen in 7 months. But if you look at it in terms of an October, which is important seasonally, we haven't seen this kind of drop, at least from Challenger, in 20 years.
Basically since 2003, and of course that was when we were seeing the effects of the popped bubble in tech. So who knows what we're going to get going forward. But the thing to keep in mind with the Challenger numbers is that these are job cut announcements, not actual cuts yet. We would normally be sitting here talking about the initial jobless claims, which still remain pretty low on a state-by-state basis. But it takes a while for job cuts to actually happen. And sometimes they don't, or companies hire people in different areas but get rid of people in a second area. So we've got to wait and see. What may be important, though, is that this is the lowest seasonal hiring plans, the holiday season hiring plans, since Challenger began tracking it in 2012, which would suggest some anticipated weakness out there, not only in the labor market, but at retailers. The Fed, obviously, in a fog. No September or October payrolls reports yet. The state jobless claims, as I said, remain low. ADP, though, on the other hand, 42,000 jobs. That's up from a negative 29 the month before. So kind of where are we? That's the issue here for the Fed. We got a lot of Fed speak today. We'll see what people are saying. But basically what it comes down to is that the Fed doesn't meet until December 10th. We need to get the government open and get that data out there so they have something solid to work with.
All right, Mike McKee, our policy and economics editor. I'll just point out that we're looking at an announcement on Twitter. This is just breaking, that Nancy Pelosi is announcing her retirement. So she has served quite a while for the U.S. Government in Congress, I think almost 40 years.
40 years, yeah. I don't think she'll be filing for unemployment benefits.
No. Well, she's probably done well. I think she has a good PA. Not a bad stock trader,
yeah,
reportedly. Mike McKee, thanks very much for joining us. Let's get back to AI right now. Qualcomm's high expectations for upcoming quarters disappointed despite signs that diversification of AI businesses are paying off. ARM gave a bullish forecast due to increasing demand for chips that run AI data centers, and ARM shares are actually up. Bloomberg Tech co-host Ed Ludlow joins us from San Francisco. And Ed, it's interesting, you know, a lot of these companies have beaten and also boosted their outlook, and yet the market isn't satisfied.
Yeah, Qualcomm fits that pattern. ARM does not. I mean, with Qualcomm, you have to remember that at the beginning of last week, when we were in Washington, D.C., Qualcomm announced its first entry into the AI accelerator market, chips for data center, and the stock absolutely took off. And so in that sense, going into this quarter, there was a very high bar for Qualcomm. If you think about their outlook for the current period, it also fits the pattern that we saw with AMD and Intel, that their core legacy business, which is basically processors for Android smartphone, is very strong. That sets the bar higher because investors don't want to hear about that. They just want to hear about the near-term benefits of Qualcomm's push into data center. But you're right, diversifying. They also had this one-time tax issue due to the U.S. tax-based change, which resulted in a net loss of $3.12 billion. But they then talked us out of that, and explained their tax position going forward. But yeah, really high bar, fits with what's been happening.
I wonder about ARM. The market is happy with what it's seen from ARM. Of course, it hasn't done as well as some companies like Nvidia over the past few years. It's done better than Qualcomm. But is it a supplier or is it a competitor? Because those lines seem to be getting blurred.
Yeah, ARM told us there's strong demand, and specifically that strong demand includes data center AI demand. ARM makes money in two ways. It licenses the blueprint or the underlying technology design for a processor, which now includes AI data center chips. And then it takes a royalty on each unit of that processor that's then shipped into the real world. And so when you consider their outlook and the reason the stock is higher, bucking the trend of others who fell after giving stronger outlooks, I guess investors are just more convinced by the narrative from the company that projects that are happening right now and projects that will happen in the future, so the expansion of the Stargate project, for example, between OpenAI and SoftBank, will result in both licensing and royalties revenues. And they've been able to communicate that in a way that satisfies investors.
I want to ask about Nvidia because Jensen Huang came out with, I thought, some pretty severe statements saying that China will, so in his opinion, it's a fact that China will win this AI race, and he's blaming, in a sense, regulation in the U.S. and, I guess, jealous of the centrally controlled communist economy out of Beijing for its subsidized energy. Isn't Jensen Huang also worried as, we've heard big concerns from Elon Musk, big concerns from Jeffrey Hinton, big concerns from many others in this industry that AI could lead to our demise, or there's not an insignificant chance of that. Does he want to just throw regulation by the wayside?
With this piece of news, there's an issue of chronology here, and the statement we just shown, control room, bear with me. I'm going to get to it in 1 second. But basically, at 4:02 Eastern time yesterday, the Financial Times published an interview with Jensen Huang, which was at the sidelines of their event, where he said literally China is going to win the AI race. That quote, but it didn't have any sort of supporting text around it. Later that evening, Nvidia issued a statement, or a statement from Jensen Huang, basically clarifying something that he has said very consistently for 2 years, which is China is nanoseconds behind the United States. And his point is, in line with many other people in the White House, that if American technology companies, his own being Nvidia in this case, aren't able to sell their technology into markets which include China, but also third markets, the Gulf, Africa, other parts of Southeast Asia, then that will give China the opportunity to pull ahead. And notice his use of the word developers there. Jensen Huang has repeated so many times that 50% of the world's AI research, or the researchers themselves, are either in China or have come from China. And that's kind of been the data point he's relied on to try and convince this White House that if the US wants to maintain a lead, slim as it is, they'll need to be able to operate in that market.
All right, it's such an interesting story with so many different aspects, and I look forward to your coverage of that starting at 11. Bloomberg Tech's Ed Ludlow, his program kicks off in just under 2 hours. Now, a shakeup this morning over at ESPN. Disney dropping Penn Entertainment and signing DraftKings as its new sports betting partner. Joining us to talk about this is Geetha Ranganathan, Bloomberg's media analyst, Bloomberg Intelligence media analyst. And Geetha, how important is this for those sports betting companies? How important is this for Walt Disney?
It's important for both, Matt. So, Walt Disney, they had that initial agreement with Penn Entertainment. They obviously shuttered that because it wasn't going very well. And I think part of that was just because Penn was, or ESPN Bet was a little bit of a late entrant to the game. Now with switching it up and having DraftKings, I mean, they are having one of the top online sportsbook operators in the market. So, DraftKings and FanDuel kind of control the entire sports betting market with about a 70% market share. So this is obviously a big, big bet for Disney, excuse the pun, on their streaming app. So, they're going to integrate the DraftKings app onto their streaming platform, and they just launched their new ESPN Unlimited streaming product in August. And I think this is really a huge, bet on that and making sure that the streaming uptake for that product is going to be very good. For DraftKings, of course, they get a huge brand name in Disney. And so I think it's a big win for them as well.
Warner Brothers comes out with revenue that misses estimates. I don't know how important it is that this company does well, since it's looking like an acquisition target anyway, right?
Yeah, results really don't matter that much for Warner Brothers. I mean, as expected, TV networks under tremendous pressure, Matt. EBITDA falling about 20%, advertising down about 20%. But then the studio is on an absolute tear this year. We've seen multiple blockbuster movies from them, whether it's Minecraft, whether it's Sinners, Superman, Conjuring, and all of that really kind of playing up well into the studio results. They're on track for, record EBITDA this year. Streaming is doing really well. But of course, the major, the dominant narrative here has been M&A. We're still looking for some more color on whether they're actually going to sell the company or split the company. The split is supposed to happen by mid-2026. So as of right now, results really don't matter that much. It's really all about the M&A buzz.
All right, Geetha, thanks very much. Geetha Ranganathan there of Bloomberg Intelligence. Let's get a look at some of the movers on our radar this morning. There is a lot going on in this stock market. Snap announced a $400 million partnership with Perplexity to incorporate its AI-powered search engine into the Snapchat app. CarMax's board terminated CEO Bill Nash, sending those shares down more than 10% in the pre-market. And e.l.f. Beauty shares have tumbled after its sales forecast was in the lowest range in 5 years. You can see a drop of 23% in the pre-market. e.l.f. CFO Mandy Fields joins me later on this hour. Coming up, Moderna rallies as it diversifies from the COVID vaccine. We'll break down its earnings and the future of mRNA next. This is Open Interest. One of the stocks on the move this morning is Moderna. It is rising in the pre-market after its cost-cutting measures are helping to offset the decline of its COVID business. Joining us now is Bloomberg's biotech reporter, Jerry Smith. Jerry, so investors are happy that they're cutting costs, but it's amazing that this company, so lauded for the incredible vaccine it delivered during the pandemic, is now having to, throw everything off the ship.
Yeah, it's been a really dramatic decline for Moderna since the peak of the pandemic. I mean, sales of their COVID vaccine has really declined. And so the company is really in cost-cutting mode now. They're cutting back on research, manufacturing that they're not using, cutting jobs, and just really trying to stabilize the business because COVID vaccines are going down year over year, about 30% this year.
The stock is down 67% in 5 years. I thought that mRNA was going to help us cure cancer. What happened to this miraculous technology?
I think that's what a lot of Moderna investors are hoping for. In a few years, Moderna says that they could get approved for a vaccine for cancer. So people who have melanoma could get this treatment. It's an individual treatment for them using mRNA technology. It's a program that Moderna has partnered with Merck on. So investors are really hoping if the company could just hang on for a few more years, that this is a real, has a lot of potential.
What's the timeline? How long till we could get that vaccine? I mean, after RFK obviously is out of
It depends on cases, but I mean, Moderna has said that potentially by 2027, this cancer treatment could be on the market. So that's really what investors are hoping for. In the meantime, they're very much dependent on their COVID vaccine, and that's declining. Their RSV vaccine has not taken off the way that the company had thought it would.
Yeah, vaccine's like a dirty word now. Jerry, thanks so much for joining us. Jerry Smith there covers the biotechs for us here at Bloomberg. Now, Nancy Pelosi is ending her nearly 40-year career in Congress. The 85-year-old Californian Democrat and the first woman to serve as Speaker of the House says she won't seek re-election next year. Let's get more now from Bloomberg's Megan Scully, who covers Congress, and there's no shortage, I guess, of octogenarians there. She's also still sticking around until she's like 87, right?
Yes, so it appears that she will be serving out this term, which ends in January of 2027. So another year and a half almost that she will be in Congress. But certainly this is the beginning of the end of a truly remarkable career. The first woman Speaker of the House. I remember being actually in the House chamber the day that she was sworn in as Speaker. And she brought children up to the lectern to really mark the occasion. And she has been at the forefront of Democrats' battles from Obamacare to Biden's big spending bill with the climate incentives and other priorities that was passed during the first 2 years of his term.
And yeah, I just had a television viewer message me saying this must be the market top, right? Because she's also been criticized for her frequent stock trading on information that your average American doesn't get. What's that looking like for Congress? I mean, has Nancy Pelosi's portfolio changed the way politicians can work in the market?
So it's her husband who is the big trader in the family, stock
they
trader in the family.
They probably talk sometimes.
Certainly. There are rules, of course, about insider trading, but legislation is always sort of waiting in the background on the Hill to prevent these trades, to prevent Congress from making these individualized trades. That has not gone anywhere just yet, but we do see it kind of gradually picking up momentum.
All right, Megan, a lot to cover. I'm sure you're very busy. Thank you so much for joining us at such short notice. Megan Scully out of our Washington bureau talking about the retirement announcement from Nancy Pelosi. Coming up, Ann Berry discusses AI, job losses, and the fragile consumer that's hitting consumer stocks this morning. This is Bloomberg Open Interest.
We're seeing a recovery, but it's tepid, it's slow, it's weaker than what we saw in terms of hiring momentum earlier this year. So cautious optimism, a bit of a rebound, but not a full-blown restoration of robust job gains.
That was ADP's Neil Richardson on the trajectory of the labor force since the dismal private payrolls data in September. Of course, today we got more data on the labor market from Challenger showing the biggest number of firings in 7 months. And if you look at it, because it's not seasonally adjusted as simply October, it's the worst for that month in over 20 years. Joining me now is Threadneedle Ventures founder Ann Berry. And Ann, we mentioned this because you're so good on analyzing the consumer and, the state of the economy from that aspect. What do you think about the labor market and how it's going to affect spending?
Well, I think the data is really mixed, and I think it's going to be very important to see that seasonal adjustment going into the holiday period in retail, seeing it in terms of travel and hospitality, understanding once this government shutdown is over, what that does in terms of implications for the labor market. So I think there's tons of noise, and I think it is simply a noisy labor market. There's no two ways about it.
It does look like Gen Z, the younger cohort is not outspending, certainly not at Cava or Shake Shack or Chipotle. What are they doing? Why aren't they buying from these fast food casual restaurants?
I think they're worried about their jobs. And I think there's two things. There's the data that's showing that Gen Z, recent college graduates, are not getting employed at the rates that they have been historically. So if you are one of those Gen Z consumers, I think you're naturally nervous about what your trajectory professionally is going to look like, and you're holding back. The other thing is, too, they have been very severely impacted by the cost of living. For any income or wage they have right now, the cost of basic things like rent definitely higher than we've seen for prior generations. It's just very difficult for that generation at the moment.
So there is, though, a lot of money out there, obviously wealthier people, but also wealthier corporations, and they're doing a ton of M&A deals.
Yes.
What does that mean for your business?
Okay, so this is what you've seen my talking point. So you know what M&A at the moment is absolutely on fire. We thought it was going to be under this administration. Here it is, and I spent a lot of time looking at Pfizer and Novo Nordisk duking it out to try and buy Metsera. People are doing expensive, extremely bold things. And I take a look and say, we've got all of this noise at the moment, all of this cheerleading around the big tech names. It's time for some of the laggards to start following in the footsteps of some of this bold M&A movement and start doing things like, and I've been, this is speculative, why is Adobe not talking to DocuSign about doubling down on their scale? Why is not Hims taking Weight Watchers out of its misery and looking to buy that kind of business, right? They're not winning on the tech front. They may as well double down on just getting scale and users and data mining as a result.
Yeah. There's so much going on. Just to stick, though, with Pfizer and Novo for a moment. What a premium. I mean, 8 times the market cap?
Yes.
How far can this go? And don't they have enough with their own Wegovy? And I guess Pfizer needs a Metsera.
Well, they also did need it. And, the thing that is sort of similar there is that the big issue for both of them is they've got blockbusters that are coming off patent and they've got blockbusters that are seeing more competition. I don't think the valuation can go much higher. I think this gets settled through the courts. What I'm looking to see is at what point do the Pfizer shareholders and the Novo shareholders outside the foundation raise their hands and say, okay, look, time out, stop. This valuation is at nosebleed levels, and it hasn't really happened yet, but it's got to happen soon. I mean, this process is fascinating, very creative.
It is fascinating, and we're fortunate to have you through the opening bell. So Ann Berry of Threadneedle Ventures is sticking with us. If you look at futures as we head to the bell, we're moving lower right now. S&P futures off 0.1%, and the NASDAQ off just a little bit more than that. We'll be right back. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are off a little bit, but consider where we are, right? Just about 6,800 in the cash trade on the S&P 500. We've come so far, so fast, and it hasn't just been one stellar year. We've had 3 in a row. If you're long this market, you are a very happy camper, and this kind of pause probably doesn't disturb you. One more sign of the exuberance is the IPOs that we've been seeing. I was just talking with Ann Berry about M&A, but IPOs are coming back too. Evomune ringing the bell down at the New York Stock Exchange. They just priced yesterday down at the NASDAQ $1 which is, it's an interesting name. They also just IPO'd yesterday. So people are coming to market. People are going public as well as doing deals. In terms of the stocks to watch, we have Qualcomm. It is down even though it beat on earnings expectations, and that's not enough these days. Everybody knows that the analysts are sandbagging. They never try and get it exactly right, or most of them don't. They're always sort of swayed by executives in order to get influence. ARM Holdings, on the other hand, beat and raised, and investors are rewarding that company. Nvidia is up slightly as well. Jensen Huang, by the way, was out with the Financial Times saying China is going to win the AI race, and he blames U.S. regulators as well as a sort of cast a jealous eye on Beijing, which is subsidizing energy. We have breaking news crossing the terminal as well on Boeing. The U.S. dismissing Boeing's criminal charges over 737 MAX jet crashes, which I guess is something that they need, but it's also something that you could have assumed, as Boeing is so important to the U.S. economy. If we had state-owned companies, this would definitely be one of them. I guess we do have state-owned companies now. We're getting there here.
Was that your prediction that the Trump administration is going to buy a stake?
No, that's not my prediction that the Trump administration is going to buy a stake, but it's like a duopoly, right? We have there's a U.S. plane maker and there's a European plane maker, and you've got to get behind your national heroes in order to win. But the Trump administration buys stake in other companies, right? So right now, Threadneedle Ventures founder Ann Berry here with us on set, and I want to talk just a little bit more about the M&A landscape, because you made some really interesting observations, also some predictions or maybe suggestions. In terms of who should buy whom. What do you think this means in terms of the banks? They have to be huge beneficiaries of this. We already know bankers are going to get paid more as we approach now, I think, $4 trillion in deals this year. Is this going to keep going?
Yeah, this is boom times for the investment banking industry for sure. And I think this is also the moment where, let's take a look at the cash balances of a lot of these businesses. One of the things that's been a recurring theme, both of the earnings cycles so far, and the previous one is buybacks, dividends going up. Companies are sitting on very large war chests, and if they're not sending that cash back to shareholders, I think they're struggling to figure out how to get supercharged growth in this environment, and so they're looking to M&A. I think this is the boom days for bankers, helping them figure out how to spend it.
Yeah, because everybody talks about, the AI trade and you want to buy the makers of picks and shovels, some people say, right? So you want to buy maybe Caterpillar instead of Nvidia at this point. But it's the bankers that make money on both sides.
And the lawyers, right? So there's a whole industry around this. Look, I think some deals can be done very well. And I think one of the issues that a lot of these companies are facing is there's only so many pure AI assets. They're privately held, right? They're backed by venture capital, and they've been raising capital at enormous valuations. We can debate whether it's a bubble or not. For a public company to go buy it, they've got to have super high conviction. And so I think that's why we're going to see more things like merging of public companies. We're going to see more creative structuring around things like mergers and then spin-outs. We're seeing that in the food sector. I absolutely think this is boom days, because the creativity needed now to get things done means bankers aren't just getting bread and butter M&A fees. It's everything around it. It's providing the money, and it's the structuring around it and the hedging that's so important.
What do you buy in AI? I mean, if it's not a debate between, the chip makers or, the data center builders, you make a great point in your note that the data is also, the data itself is also an asset. But where do you find that? Where do you get the best data?
Well, I think one of the things I'm trying to think about in terms of looking for value, like I'm holding all the big AI names. We all are, right? I'm overweight them if you take a look at the concentration issues in the overall indices. There are certain companies like ZoomInfo, for example. I actually spoke to the CEO recently. And what they're doing, they've been around for a long time. They've actually been around since the 90s. And what they're doing at the moment is they're buying up tuck-in acquisitions of businesses that aren't necessarily AI forward, but they've got an enormous installed base of data sitting in, on-premise, for example, ERP systems. And companies are trying to move to the cloud and then to something more forward-thinking. But by buying companies that have been around for a long time, it's a way of getting a proprietary data set that it's quite difficult to get otherwise. I find that interesting, and that's part of my thesis around Adobe go by DocuSign, right? Go double down on sources of data and build out proprietary data sets if you can't be the person to figure out the actual AI models.
I mean, I always wonder if AI is going to eat software's lunch. We were talking to Mark Douglas about this yesterday, and I guess the idea is, why hire a company or subscribe to a software service that you can just have, your own kids write with AI software yourself? But the data is really the moat, right?
Yes, the data is really the moat. And so that's why, if AI is going to eat software alive, I think of it as though some of the software OGs, whether it is Adobe, whether it is Salesforce, to pick on Salesforce for a moment, whether it's some of the original cybersecurity companies, right? Getting that data, getting the proprietary data, and then ultimately perhaps using somebody else's AI to optimize it, or licensing that data out, which the social media platforms are doing, right? I think they're going to have to pivot, because to your point, there are too many low-cost free options out there that do the rudimentary jobs just as well and much more cheaply.
What do you think, by the way, I'll put you on the spot here, about Jensen Huang's statement that China is going to win in AI. And I thought it was interesting that he blames regulators, as if we shouldn't regulate this technology at all, right? I put a list together of the biggest names in tech from Jeffrey Hinton, the godfather of AI, who says there's a 20 to 30% chance that AI will destroy humanity in the next 3 decades. Or Elon Musk, who also thinks that there's like a 20% chance that it kills us all. Here it is. Dario Amodei from Anthropic, 25% chance of things going really, really badly. He says not an extinction event, but a catastrophe. Like, doesn't this tell you we need to regulate this technology?
Is it saying that we need to regulate this technology, which I do think we do in terms of things like privacy and understanding the impact on young people when it's consumer facing?
And we've seen how bad social media is for society, right?
We absolutely have. I look at this and say, I don't necessarily read it as those who are on the inside saying things that means we should think about regulating AI more. I think it's basically saying we need to understand it better so that we've got the tools available to try and mitigate the risk that AI becomes something that is a catastrophic event creator. Now, for Jensen Huang's comments, 2 things that have struck me about the timing. Jensen Huang's comments that China's ahead of us and sort of blaming regulators came on the same day that Sarah Fryer suggested that the United States government should be supporting the funding of AI investments. And the word I think she used was backstop. She subsequently said, oh, I didn't mean it. I muddied the waters by using that specific term.
Sarah Fryer, the CFO of OpenAI. Yeah.
And so implicit there was the US government should now be propping up OpenAI's spend, which could be up to $1 trillion. I think those are 2 sides of the same coin, right? On the one hand, you've got Jensen Huang saying, we need to pull back on regulation. On the other hand, you've got OpenAI saying we should have government intervention in terms of providing the capital. And I'm not sure you can have one without the other.
It's just, to me, it's so fascinating, especially after the election, right? You've got Zoran Mamdani, who wants to start maybe a couple of grocery stores funded by the city here in New York, and people railing against that so-called communist idea. Meanwhile, they think we should be buying stakes of companies in Washington and controlling the economy from the federal government?
Yeah, well, I think there's 2 magic words that get people to fall on one side versus the other of that, and that's national security. I think no one's arguing that having city-owned grocery stores is a national security policy. Where I do think the waters are getting muddied is on what does national security mean? How much does it justify government intervention? And by the way, Matt, we saw that in the hearings in the Supreme Court yesterday, right, around the tariffs and the national security argument to justify the way in which some of the Liberation Day tariffs were rolled out. I think on AI specifically, and just to go back to Jensen Huang's comments, there is a problem. There is a problem because we do have the capitalist structure that we have here in the United States that's allowed investment and creativity to flourish and innovation to flourish. But if we are now at the point where I think the national security requirement is we need to get more funding out there than the private market can sustain, and do we pull back regulation to accommodate it, I think there's a real debate that needs to be had unemotionally and dispassionately. And it's not being had yet. And I think one of the reasons why not, folks, I do not think trust the tech leaders to exist in an unregulated world. And to do the right thing, partly because of the social media, partly because of the politicization of it. And the trust needs to come for the regulation to pull back.
I always learn something when you come here.
Do you?
So I appreciate
Thank you.
Your time. I will suggest that maybe healthy food, education, and love for the youngest in our society is the most important national security.
Okay.
But I haven't had much sleep, so maybe I'm getting a little bit emotional.
I feel like we need a chat about AI and online dating to get to exactly that point. We have to talk about the apps.
All right, I don't know if I can have that discussion. I'm a married man. Threadneedle Ventures founder Ann Berry, they're coming up. e.l.f. Beauty sinks as the company's annual forecast underwhelms the street. We'll speak to the company's CFO, Mandy Fields, next. This is Bloomberg Open Interest. Time now for our top call. Some of the analysts in action in focus this morning. First up, Wall Street feeling better about Caterpillar stock after its investor day yesterday. Cat's management provided financial targets for 2030, saying it can grow sales up to 6% a year. HSBC raised its rating on the stock to a buy. JP Morgan says a re-rating for the company may be on the horizon. Next up, RBC Capital is downgrading Bumble. Speaking of dating sites, warning that the online dating provider faces stronger headwinds. The analyst called Bumble's weak third quarter and limited product innovation a value trap in a market where only a few top brands will thrive. And finally, analysts are split on e.l.f. Beauty's outlook. The company's weak full-year guidance overshadowed optimism around its Rhode acquisition. Piper Sandler cut its rating on the stock, saying the main brand no longer justifies a high valuation. JP Morgan kept its overweight rating, calling the guidance disappointing but likely conservative. For more on e.l.f. Beauty, we welcome the company's CFO, Mandy Fields, joins us now live. And Mandy, is this a conservative outlook? Are you under-promising in order to over-deliver?
Hi, Matt. Thanks for having me this morning. Look, we're super excited about what we have going on here at e.l.f. Beauty. We just issued guidance for the first time this year. 18 to 20% net sales growth is what we expect. And I would say if you look across consumer and think about the consumer backdrop that we're operating in, 18 to 20% is pretty awesome, just given that backdrop. So we're feeling good about what we've issued from a guidance standpoint. We feel like that puts us in a solid position. And if you recall, the reason why we had not issued guidance is largely because of the tariffs. And now that we have a little bit more certainty on that front, we felt we were in a good position to issue guidance.
What is the consumer backdrop? How would you describe it? And I should note, yesterday, the Treasury Secretary, Scott Bessent, tweeted that jobs are booming and inflation is falling. Do you feel that?
Yeah. So I heard the same, and we did see jobs, ADP information come out. Look, I would say that the consumer is continuing to be choiceful in what they purchase. And the great news is for e.l.f., they continue to purchase e.l.f. Our consumption on a year-to-date basis is up 10%, which means that with the dollars that the consumer does have, they're continuing to vote for us.
It is the slowest growth that core brand, the e.l.f. Eyes, Lips, Face brand, has seen in 5 years. So is this just a maturing of the brand? Is there some saturation out there?
Well, I would say that, look, we have now delivered 27 consecutive quarters of net sales growth for e.l.f. Beauty. For our e.l.f. namesake brand, we've delivered 27 consecutive quarters of market share gains. And so as long as we continue to outperform the category, which, by the way, in Q2, we outperformed the category by 3 times. If we continue to outperform the category and build share, we're doing exactly what we've set out to do.
I'd say we were talking about e.l.f. in the morning meeting, the editorial meeting, and most of our time was devoted to Hailey Bieber. Most of our conversation, that is. What can you tell us about how hands-on Hailey has been and how promising this brand is for you? Rhode
is an incredible brand, and Hailey is continued to be involved. In fact, November is her birthday month, and if you're following her or Rhode on social media, you can see that next week on the 12th, she's going to be dropping like her birthday kit, which is incredible. A lot of people excited about that. We're also launching Rhode in the UK next week on the 10th with Sephora. And so we are super excited about what Rhode brings to the e.l.f. Beauty family. Hailey is very much involved, and we just love what we're seeing on that brand. In fact, we outlooked that we believe this brand will be $300 million on an annualized basis for this fiscal year, which represents a 40% year-over-year growth in that business.
And Mandy, finally, what can you tell us about your input costs? I mean, on the idea of inflation coming down, when I look at the numbers, to me, it looks like it's still pretty high, right? 50% above the Fed's target at 3%. The things that you need to buy to build your products, what are those prices looking like?
I can tell you on a weighted average basis, tariffs have impacted us. We've been paying about 60% tariff this year. And so that is certainly impacting our costs as we look out. Now, the great news is, as we heard last week, that the tariff rate would be reduced down to 45% level from the 55% it had been previously, had been as high as 170% earlier this year. And so that at least is a glimmer of some relief on the tariff front as we head into the balance of the year and into next fiscal year.
Any hope for a refund if the Supreme Court decides against IEEPA?
Well, I'm staying tuned for that one.
All right, Mandy, great having you on the program. Thank you so much for joining us. Mandy Fields there of e.l.f. Beauty. Coming up, it's a big day for Elon Musk and Tesla as shareholders vote on his $1 trillion pay package. We'll give you the details next. This is Open Interest. Tesla shareholders voting on a $1 trillion pay package that could decide Elon Musk's future at the company. ARC's Cathie Wood, a longtime Tesla bull, told Bloomberg how his absence would change her outlook.
We would feel comfortable with the robotaxi part of the model, but we would not be able to build with confidence the humanoid robot part of the model.
Craig Trudell leads Bloomberg's global autos coverage and, I guess, robot coverage as well. Joining us now from London. I mean, a car, especially if it's self-driving, is a robot. Craig, the interesting thing I think about this $1 trillion pay package, and it garners so many headlines because obviously no one has $1 trillion or has ever been paid anything close, but the targets that he has to reach to get this seem impossible anyway. So why does it matter?
Yeah, I think there are some folks who sort of, look at some of those most ambitious targets and say, well, geez, if he reaches any of these objectives, then maybe he is worth these payouts. I think one of the things that you've seen, one of the sort of lines of criticism that you've seen over this package is the fact that some of the, less ambitious targets aren't necessarily that difficult to achieve. I think when you talk about, sort of cumulative vehicle sales, for example, that Tesla's not that far off. Even the market cap objective, the very first one, is $2 trillion, which is, quite ambitious for any company. But for, Tesla, this is a company that in the last few months has, gotten back into the, roughly $1.4 trillion range. So is that much of a leap to make over the course of 10 years? It's not, a substantial return if you're a shareholder in this company necessarily.
So, but at the top end, $8.5 trillion, if he hits that market cap, investors, I'm sure, would be happy to give him an eighth of that for, quadrupling their money and then some.
Yeah, I think, and the way that we should also, think about this, too, is that if we go back to 2018, people referred to the objectives that were laid out for Musk then as, moonshot targets. I think it was kind of fascinating to see the board of directors, phrase in this proxy this year as Mars shot targets. So, conveying that, we did this already before and we're going to try and do it again. That being said, I think, there's also, a lot of concern about dilution, even with sort of each sort of step of stock being awarded to Musk. I mentioned the sort of less ambitious targets. It takes a combination of performance milestones and market cap milestones being achieved in order for him to get more stock awarded to him. But for each time that he is able to pull that off, it's a little bit of stock and a little bit of dilution for everybody else. If
some of those less ambitious targets aren't impressive, I think the most impressive would be 20 million in annual auto sales. That's like twice what Toyota does and what, 20 times what Tesla does, or at least 10 times.
Right, but I think the 20 million, that's a key. I believe that 20 million is actually a cumulative figure that they've set out for him. So that was a target that the company set, for some time, that, eventually they wanted to get to 20 million a year. And I think a lot of auto industry folks looked at that figure askance because, to your point, we've seen the likes of Toyota and Volkswagen reach that level, but we have not seen any automaker reach, double the 10 million that VW and Toyota have pulled off.
It would be a lot of cars to sell in a year for any single car maker, let alone two put together. Craig Trudell, thanks very much for joining us on that. Coming up in the next hour, Citi Wealth CIO Kate Moore joins us on set, plus I Squared Capital's Adek Wahba. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is on assignment in Miami. I would say lucky, but she has to work. We're looking at a little bit of a drop in markets today, but we had a swing to the positive yesterday, and we're up around 6,800, a little less on the cash trade. So not bad if you've been invested in this equity market. Coming up, AI and cost-cutting measures are allowing firms to eliminate more and more jobs, with October layoffs, at least according to Challenger during Christmas, hitting the highest level for this month in 22 years. Caution over lofty tech valuations lingers. Qualcomm is the latest chipmaker to deliver a bullish forecast and still disappoint investors, at least judging by the sell-off in today's shares. And as other consumer stocks struggle, one stock that's bucking the trend is SharkNinja. We'll talk to the CEO about his thousands of TikTok promotable products later this hour. But we begin with signs of softening in the labor market. Ann Berry of Threadneedle Ventures weighed in.
The data's really mixed, and I think it's going to be very important to see that seasonal adjustment going into the holiday period in retail, seeing it in terms of travel and hospitality, understanding once this government shutdown is over, what that does in terms of implications for the labour market. So I think there's tons of noise, and I think it is simply a noisy labour market. There's no two ways about it.
Kate Moore joins us now, Citi Wealth Chief Investment Officer, and I've been quoting a Scott Bessent tweet for a couple days now where he says jobs are booming and inflation is falling, making his point that we're reaching the Trump golden age. But are jobs booming?
We're not seeing jobs booming. And look, I'm going to tell you, I'm going to fade a little bit the Challenger report today. And we're focused on a bunch of other data to kind of gauge the labor market at this point, including the jobless claims, which we can obviously gather at a state level, anecdotes we're getting from companies from earnings season, and then some third-party data, and alternative data that we use. And the labor market is okay. I wouldn't classify it as booming by any stretch. But companies, I think, are being really smart.
You might if you were the Treasury Secretary.
You might have a different perspective, but we think the labor market is fine, but is a little bit more frozen for the obvious reasons we've been talking about. And I think as we get more AI use cases and people understand whether or not there's efficiency and productivity gains as a result of these investments, we might see a slightly different job market in 2026. I can't tell you what it is, if there's hiring in different places or if there are cuts, but I think that's a big overhang, as well as this uncertainty around tariffs, frankly, and whether or not it's going to lead to slower economic growth or perhaps a boost if there are refunds.
Even if you were to classify the labor market as weak, is that a good reason for the Fed to cut rates? I mean, is that another rate cut or 2 or 3 going to spur companies to hire?
I don't think so. And frankly, I share a view with some of our other economists that the inflation story is a little warmer than we would have liked at this point, or with the Fed in a potentially more extended easing cycle. I think it was very fair, frankly, to say we're going to wait and see what happens before we make a decision in December. And in October, and I've joked and said this, if I was on the FOMC, I don't think it would have been a clear decision for me to cut rates, given where we are in inflation. And, we're seeing some percolating across goods and across services. And, at this point, it looks like policy is appropriate for a labor market that's solid, maybe frozen, but solid, and inflation that's higher than it was 6 months ago.
We saw some movement yesterday in shares like Mattel, for example, on optimism that maybe the Supreme Court would say these tariffs, at least through IEEPA, are illegal. I think that is kind of wishful thinking. But otherwise, in this market, tariffs don't seem to matter. The Fed doesn't seem to matter. The China relationship doesn't seem to matter. It's all about AI.
Yeah, look, we've shrugged off a lot of risks. One of the things we've talked a lot about is the K-shaped consumer, but there's also a real K-shaped economy and K-shaped capital expenditure path right now in the U.S. economy. And there is a real differentiation between the haves and have-nots, both in terms of the earnings growth, in terms of the margins. And a lot of this is accruing, of course, we know, to the large caps. But people are uncomfortable. I mean, the big thing we're getting from clients over and over again is we're concerned around valuations. We're concerned around the duration of this move. What should we be doing? We don't want to put more cash to work. And I find that we're encouraging our clients over and over again to think about the medium term and the fundamentals in the AI and tech side. But they're worried that the move is overdone. I'm not, but it's been a big source of conversation.
I was looking at, I think Torsten Slok sent an email around this morning showing, on the Warren Buffett valuation level, which is, stock market capitalization of GDP, we're higher than ever. And if you look at the Shiller-Cape ratio, we're approaching 2,000. Why aren't you worried about valuations?
So I think valuation needs to be part of your process, but not the anchor to your process. And here's why. Because when we're comparing current multiples in the market relative to history, number one, it doesn't take into consideration the sectoral and market cap differences with history. It doesn't take into consideration balance sheets or the earnings profile or the debt profile. It is not an apples to apples comparison. 14 times one time at one point is very different than 14 times today. And I'm not saying we're going to trade back to 14, by the way, to be clear.
No, but that's a great point.
I think we can trade at higher multiples because we have better information, balance sheets are stronger, and the market composition, the index composition is very different. Do I recognize that we are at the top end of a historic range? 100%, and we have to factor that in. But I'm not going to let that stop me from leaning into the highest quality compounding earners.
I noticed when we saw the opening bell today, we had two IPOs ringing the opening bell, one at the NYSE, one on the NASDAQ. And we've had $4 trillion of M&A already this year. We've had $6 trillion of bond issuance. So a record there, which seems to indicate financial conditions are not very tight, but also there's a lot of exuberance and confidence in this economy.
Yeah, let me just underscore that point. Financial conditions are not tight. They are relatively loose at this point. And I think that's really encouraging CEOs and entrepreneurs to think about coming to the market. We have been encouraged by the deal activity and what that does for the financials. We've been constructive on the financial sector, not just because I work at a bank, but also, potentially watching what deregulation does in terms of getting more deals to market and getting more issuance. So I think that's going to be a theme into the beginning part of 2026. But it's a disconnect, as I'm saying, with some investors who are invested, but are a little bit worried by the duration of this move. And I think because everyone is not all in all the time and investor sentiment is not exuberant, there's potential for further upside into year end.
What do you think about private versus public? I noticed that Schwab is buying Forge, which is, you can get privately traded shares on that platform, but also alternative investments that for years, if you are a teacher with CalPERS, you've been able to access this, but I haven't been.
Yeah.
And should I be looking for private credit or private equity exposure as part of my portfolio?
I think with any entry at this point, you need to be thoughtful about your own liquidity needs and your time horizon. And I would say we have to expect that the return of capital in private equity and private debt is going to take a little bit longer than it may have previously. And there's a role for it in some clients' portfolios. I don't want to say I'm skeptical. I just want to be more measured about it. People have been, pounding the table. Now is the time to add. We think there are very specific funds and managers that we really want to see in our client portfolios. But it is not every fund and every portfolio manager that we want to see represented.
As we approach the end of the year, and we are getting near it.
Can't believe it.
I can't believe it either, but when you look back and think about all that's happened, if you'd known that, but not seen returns, you might have thought it would be a horrible year for risk assets, right? But it's been amazing.
It's been amazing. Actually, when I look at asset class returns over the course of 2025, I've made this bit of a joke. If you told me that the best performing asset would be gold and the worst performing asset would be the dollar and the second best performing asset would be emerging market equities, I would be like, I'm not really sure what that environment is, that where you get awesome gold, which is kind of often a risk off and diversifier, awesome emerging market equities, which tends to be a risk on, and then the dollar weakening all at the same time. So it has been a complicated year for investors, and it's been difficult because we are reaching these new all-time highs over and over again, and there's been a tremendous amount of news flow. We would tell everyone that despite the geopolitical issues, despite the macro volatility, and despite this disruption in AI and tech, now is not the time to step away from the market.
All right, Kate, great having you in the studio. Thank you so much for joining us. Kate Moore there is the CIO at Citi Wealth. Let's get a check on what's going on in the markets right now. We're looking at red arrows that are increasing throughout the early part of the session. We've only been trading for 40 minutes now, but we're down 0.2% on the cash trade in the S&P 500. 67.53 is still pretty impressive considering where we've come from. The NASDAQ right now down a little bit more than 1% as these big tech stocks, even when they beat expectations, are falling, and that's because expectations are just too low. There was a story in the Wall Street Journal about analysts just not really doing their jobs. The U.S. 10-year yield right now, it's been hovering around 4.1% and still holds there, down 7 basis points, but still at 4.0890. In terms of the single stocks moving this hour, Qualcomm is one of those that delivered upbeat sales and profit forecasts, but still left investors underwhelmed. ARM gave a bullish forecast, and it is being rewarded, but only to the 2.5% now. And Disney signed a new multi-year deal to make DraftKings the official betting site for ESPN. We, as a society, know about the dangers of gambling, and yet we encourage it. Coming up, the AI data center boom is eating up other manufacturing capacity. We'll discuss that with Wahba of I² Capital in a bigger conversation about infrastructure. This is Bloomberg Open Interest. Getting out of high interest, look at what's making headlines around the world. Nancy Pelosi is ending her nearly 40-year career in Congress.
That is why I want you, my fellow San Franciscans, to be the first to know. I will not be seeking re-election to Congress. With a grateful heart, I look forward to my final year of service as your proud representative.
The 85-year-old Californian Democrat was the first woman to serve as Speaker of the House. Pelosi's retirement creates a hole in national Democratic leadership, underscoring questions about the future of the party that is very old. I mean, both parties are very old, but she's going to be 87 before she leaves because she's sticking around for a while. The U.S. will slash domestic flights by 10% across 40 major markets starting tomorrow to ease strain on air traffic controllers during the record-long government shutdown. Cuts will roll out gradually through the weekend, reaching 10% next week and potentially grounding up to 1,800 flights in total. The FAA citing mounting fatigue among unpaid controllers as delays and absences surge. International routes will be spared, according to Sean Duffy, the Transportation Secretary. And U.S. companies announced over 153,000 job cuts in October. It's the highest for that month in over 20 years. Tech and warehousing led the losses as firms like Target, Amazon, and Paramount trimmed staff. Analysts say AI adoption, weaker spending, and rising costs are driving cuts and slowing hiring across industries. Let's stick with AI. Massive investment in AI infrastructure is eating up other manufacturing capacity in the United States of America. Spending on factory construction is down 2.5% so far this year, while that for data centers is up almost 18%. And joining us is someone who is an expert on these giant infrastructure projects. Wahba, founder and chairman at I² Capital, an independent global infrastructure investor, is here on set. I'm pleased to say, Sadek, great to see you here. I have been thinking about you so often when we talk about these huge, 10 or 20 gigawatt projects, because, the infrastructure needs are gigantic. And I imagine the spend is just off the charts. 18% doesn't even really do it for me. So what's the outlook like for you?
The outlook, first of all, thank you very much for having me here. But the outlook is quite exciting. So look at the amount of electric consumption we will need by 2030. It's the equivalent of Japan's consumption. So think about that. So by the way,
that's just the additional consumption that we'll need.
Just for AI data centers. AI data centers will require the equivalent of Japan's consumption by 2030, the fourth largest economy in the world. So the demand for infrastructure and AI data center is and will continue to be huge. There's about $1 trillion that you need to spend over the coming 5 years just for OpenAI. And that means that their revenues need to exceed by 2030 about $1 trillion. So these are very large numbers. The question really is Is there the demand for it? Question mark.
Will the revenue catch up?
Will the revenue catch up? Will the technology change so that you don't need that much of infrastructure? We know that that technology is changing by the day.
The Chinese seem to be able to do it, for example, with less energy.
Absolutely. And so when you combine all of that, you want to be able to be sure that that infrastructure is going to be usable over the coming years, irrespective of whether that boom or that bubble is a bubble or not. And so that's the most important thing. You need to be able to assess what are the genuine needs. And today it's very difficult to do that.
Well, what is your assessment? I mean, how likely do you think it is that we really get the return on investment to justify this kind of spending?
I think it all depends where it is that you're looking to invest. So at this stage, we're really data dependent. We don't have a clear view as to whether it's going to go up or whether there's going to be a correction or whether that is illusory or not. So you have all of these elements coming in. When you think about investing in infrastructure, what is it that ultimately investors look for? I think they look for stable cash flows. They look for predictable cash flow over a period of time. So traditional data centers that does co-location, that does cloud-based, look at Bloomberg, needs to have cloud access. Those traditional type of infrastructure, data centers, continues to be very valuable. Edge data centers, all of that continues to be very valuable, and people should continue to invest. And you're going to see edge data centers and AI migrating together, right? So that's an important element that people should invest in. All that, I would say, is stable, good visibility on cash flow, long-term contracts. When you go into AI data centers, whether it's for LLM models or for inference or whatever, then you have the risk of the counterparty, the location. At the end of the day, it's a real estate investment you're also making. So location is extremely important. So all these elements come into play. So you have to really deconstruct that investment and ensure that all of the components that you're investing in really fit the thesis that you're providing to investors.
By the way, I always wonder if we have the pieces in place, like, for example, the grid, or if we can build or improve those pieces to make this work. And you led the infrastructure business at Morgan Stanley for a long time. At I Squared, you're the go-to man for infrastructure in Washington, in London, in Paris. Who's prepared for this? Is anyone in the Western world got a grid that can already work?
The short answer is not yet. The ones that are investing heavily in the grid are two countries, China and India. India is doing a massive effort in developing the grid, not for AI, for its own consumption, because remember, it's growing every day. China is also investing massively in the grid. The fundamental problem we have in the United States is that we have challenges in doing interstate projects. It requires environmental approvals, it requires Public Utility Commission on the different states that the grid is going to cross through. So, and then the amount of investment is so large, you have to ask what kind of return you're going to get. So that, in my view, is where the market is not completely functioning and where government needs to come in. So this administration, by the way, has done that. So they've said, we need to be able to ensure that we're going to win that race, right? The AI race.
Yeah.
And so I'm going to buy 10% of Intel. I'm going to invest in lithium mining. I think that's exactly the right approach. We should try and do the same thing in developing the transmission grid across the United States.
I mean, it makes sense, the chips and the rare earths, and I think Jamie Dimon also said he agrees that for national security we need to be buying this. I wonder about the companies. Which companies are indispensable when you're doing giant national or transnational infrastructure projects? Is it the Siemens, the ABBs, the General Electrics, the Caterpillar? I mean, who are the biggest names in big infrastructure?
All of the names you've just mentioned. So think about today, data centers, for example, are using temporary power to be able to feed and provide electricity to those data centers. That's extremely expensive, but at some point, it's worth it. And so that's the Caterpillars, that's the GE, anyone that's producing reciprocating engines, basically the equivalent of your car, right?
Yeah.
To be able to function and provide electricity to the data centers, all of that. Construction companies, huge demand for it. Engineering companies, where unfortunately the US lags relative to European counterparts or even Chinese counterparts. You mentioned Mitsubishi, you mentioned Siemens, absolutely. So all of these are the ones that you'd want to look at involving them. When we do these projects, these are the companies we work with all the time.
All right, Sadek, we could spend more time and we should spend more time talking with you about this. I really appreciate your time today. We'll have to have you back soon and do maybe a longer form piece because it's such a huge undertaking and no one knows more about it than you. Sadek Wahba there of I2 Capital. Still ahead, SharkNinja boosting its earnings outlook. We'll speak with the company's CEO and get his take on the consumer. He's in a good spot to judge. This is Bloomberg Open Interest. Get a check on how the market is doing right now. I use the move function on the Bloomberg terminal. I think it's the most dynamic way to look at an index because you've got so much information in one place. First off, the breadth is where I always start, and it's pretty evenly split right now. 240 stocks gaining, 260 stocks down. You can see that we opened higher, had a dip, and now we're headed back up, but not to break even. So down about 1/3%. Apple is one of the leaders right now, adding 4 points to the index. Datadog is adding 1 1/3 points to the index. Very interesting to see a smaller stock there. Investors really impressed with what they heard from Datadog. Broadcom also adding a point. On the downside, Nvidia, when it's off 1%, because it's a $5 trillion company, it's a huge weight, and that's why it's down or taking 5 points off of the index. Microsoft is taking 5 points off as well. Coming up, SharkNinja joins a list of companies boosting its full-year outlook. We'll speak to the CEO.
Tariffs have impacted us. We've been paying about 60% tariff this year. And so that is certainly impacting our costs as we look out. Now, the great news is, as we heard last week, that the tariff rate would be reduced down to 45% level from the 55% it had been previously.
That was e.l.f. Beauty's Chief Financial Officer, Mandy Fields, speaking to me in the last hour. Another consumer stock in focus this morning is SharkNinja. The company raised its full-year outlook today after beating earnings estimates for the third quarter. That's pushed the stock to gains in today's session. We're looking at a year-to-date chart, but it is clawing back some of its 10% loss this year. As you can see, now it's down to less than 2%. Joining us now is Mark Barrocas, CEO of SharkNinja, as well as Shelley Banjo, Bloomberg's managing editor for global business. Mark, thanks so much for coming on the program. I wonder, first of all, if you can tell us how tariffs are affecting you. Mandy Fields mentioned some pretty large numbers in percentage terms that they're having to pay. Is it the same range for SharkNinja?
Well, Matt, first off, thanks for having me. I guess I want to start by saying, this is 10 consecutive quarters of double-digit top and bottom line growth for SharkNinja since we've been on the New York Stock Exchange. And our consumer problem-solving machine was on full display this quarter. I mean, we grew our top line over 14%. We grew the adjusted EBITDA over 21%. Our gross margin rate, in fact, grew 90 basis points in the quarter. And we leveraged our operating expense. So we had a great quarter. I mean, we've been managing with tariffs now for quite a long time. I mean, 4.5 years now.
Well, I mean, that's evident your great quarter by investor reaction, right? The shares are up more than 10%. So I think everyone understands you did well. I still would love to hear you quantify the effect of the tariffs on you thus far.
Well, I mean, the tariffs on our gross margin rate this quarter, at a macro level, didn't have any impact. We grew our gross margins. Now, let's keep in mind, our business continues to grow and diversify outside of the U.S. We're growing our business outside of the U.S. faster than inside of the U.S. We've diversified nearly all of our supply chain for the U.S. outside of China. We're making all of that product now, for the most part, in places like Vietnam and Thailand and Malaysia and Indonesia. And yes, while there's tariffs there as well, we've done a great job to mitigate a lot of those through value engineering and cost optimization and product mix. So it's not one silver bullet, Matt, but like we have to deal with the deck of cards that are handed to us. Yes, there are tariffs, and we're doing the best we can to manage through them.
Mark, you held back on across the board price increases, but you've made some price increases. You talked a little bit about that in previous months. Tell us a little bit about how that's impacting the consumer. As you raise prices on some of these important products, how is that impacting sales?
Yeah, I mean, we have raised prices, and they have been minimal and really carefully implemented. Look, we're not the highest priced products in the market. We're not the lowest priced products. When consumers buy a SharkNinja product, they're getting great performance, great quality, but they're also getting it at an extraordinary value. And so even with the price increases, we've really still maintained that strong value. You could buy a SharkNinja product for $59 for your home. You could buy one for $999 for your home. So, I mean, we're across so many different price point segments, but it's all about this concept of affordable, accessible innovation. And I think we've been able to maintain that, Shelley.
And tell us about the new factory you've been talking about, this idea of building a factory in the U.S., bringing some of this manufacturing back. Which of your products could you actually make in the U.S.?
Well, Shelley, we've been looking at this now, for quite a number of months. And, it's obviously not our whole assortment, but, we're growing our business in the cooler category, outdoor coolers called the Ninja Frostvault. We think that's a product category that could potentially be brought back to the U.S. We've grown and expanded in outdoor heaters and outdoor grills. We just launched a product, Shelley, called the Ninja Fireside 360. It's an outdoor heater and fire pit. Has a big amount of components of steel and aluminum in it. So we're looking at product categories with a lot of steel and aluminum that doesn't maybe have a lot of high labor count to it. But coolers, outdoor products, seem like something over the next few months we could try to nail down.
It's interesting, Mark. I wonder where you're looking at putting a factory, because we've done some reporting on how much capacity AI data centers have taken up. So if you want construction crews, if you want someone to lay down cement for you, if you want someone to run electricity and water for you, you got to stand in line behind these big, rich AI data centers. So where are you thinking about building a factory, and what do you think about that scarcity of capacity?
Well, look, we don't manufacture anything ourselves. I mean, we work with third-party manufacturers. And so there are a number of third-party manufacturers that are looking aggressively, areas in the U.S. South. And so we're talking to a number of them. And I think over the course of the next few months, we'll have that more nailed down. But we won't actually do it ourselves. We will partner with a third-party company.
All right. So you would have someone else build those products for you. Would you have to raise prices on the stuff that you build in the U.S.? Because even, I would imagine, roto-molding a cooler in the U.S. is more expensive than it would be, say, in Indonesia.
Matt, it's a great point. But when you take into account, I think, the tariffs, the freight, the landed cost on the product, we're looking for things that we could bring it into a relative parity place and maybe have an advantage on the inventory management side or working capital or things like that.
Mark, as we're going into this holiday season, it's going to be super competitive. You've talked a little bit about that in the past. How are you going to protect your margins and also continue to give those discounts over to consumers that they're expecting for Black Friday and Christmas?
Well, look, Shelley, I mean, that's what we do. I mean, we've been in full action here. I mean, again, I'll go back 4.5 years ago when we made our first product outside of China. I mean, the company has a really proven supply chain model that's been able to drive cost out of our products as making sure that we're delivering strong value to the consumer. As you said, I mean, we're obviously watching very carefully the government shutdown. I mean, we're hoping that that gets resolved and that consumers, can have confidence in the government. But we've got some great innovation for the holiday season. I mean, we've innovated in outdoor heaters and fire pits. We've solved the problem of stainsiety with our Shark Stain Force. We brought at-home facial solution that extracts, moisturizes, and depuffs your skin. I mean, we're having fun here at SharkNinja, and we're developing products and solving consumer problems in ways that, others aren't.
What's next? What comes after the beauty? You've gone into beauty, you're going into med tech. What's next that you haven't done yet?
Listen, we're in 38 different product categories today, and I think there are lots and lots of places inside the home and outside the home for us to solve consumer problems. I think there's a lot of things the consumer does outside of the home that they're not able to do inside of the home. So, I think there's a great roadmap of kind of what's to come.
You are really strong, some would say geniuses, in coming up with these products and the viral marketing campaigns. I've noticed recently that, if you're using one of these weight loss drugs, you also need a food scale and a food processor and a protein shake mixer. And so it makes you buy this whole universe of products. Are there other fads or trends where you see knock-on effects like that?
Well, we're constantly, we're scouring social media. We're looking at culture. Matt, look at a product we just came out with called the Ninja Blend Boss. It's completely reinventing what you just talked about in terms of at-home smoothie making, but it's doing it in a really unique and fashionable way. Look at, we just launched a product actually with a partnership with Tom Brady called the Ninja Crispy Pro. It's a non-toxic glass air fryer that you could see into with multiple vessels. So again, it's just fun, exciting ways for the consumer to be able to cook better for their families, clean better, feel beautiful, spend more time with each other, and make their homes and outside their homes, just a better environment for them.
Mark, great to get some time with you. Really appreciate your time. Mark Barrocas there of SharkNinja, and our thanks to Bloomberg's Shelley Banjo as well, who runs our company coverage here at Bloomberg. Coming up, from Tom Brady to Fran Tarkenton, the great quarterback, reveals a new AI workspace because he's gone in to software and has a product for small and mid-sized businesses. We'll speak to Fran Tarkenton next. This is Bloomberg Open Interest. Football Hall of Famer and software executive Fran Tarkenton is entering the AI race. His company, Tarkenton, is revealing PIPIQ this morning, a private AI workspace for small businesses that aims to prevent the kind of data leaks seen from public AI tools like ChatGPT. Joining us now is the man himself, Fran Tarkenton, along with Tarkenton President Will Adams. Gentlemen, thanks so much for coming on the program. Fran, I have to start with you because I grew up watching you play football, and I wouldn't have known that you were also a software entrepreneur, and going into this space is pretty impressive. How did this all happen?
Well, in 1961, I was drafted by the Minnesota Vikings, and I was on their first football team. My salary was $12,500. I worked. I worked when I was in college. I worked when I was playing football. I started businesses back then. I've been doing this for 40 years. And now the technology, as you know, and all your listeners know, is just going crazy. AI, AI, AI. And we've been working a great deal the last 25 years with small business entrepreneurs. Nobody helps them. They help the big guys. And if you, in our deal with PIPIQ, our guys cannot afford to pay $1 billion here and $1 billion there to get the big guys to help them with this new marvel. And so anyway, we've been doing small businesses for 25 years and helping them get to more a marketplace in a more cost-effective way. And mission of business is to help people. The mission of business is to have products and services that help them do better. And now with AI in there and PIPIQ, we can do that. We have built this ourselves. We built it in the last 6 to 8 months, and the response is great because we're helping small business people go compete at a better pace than they've ever been able to do.
All right, so Will Adams, tell us how you, with one of the greatest competitors of all time, are competing in this space. What does PIPIQ do that ChatGPT doesn't?
Tell him,
well, great question, Matt. Yeah, no, thank you for having us, Matt. No, there's absolutely a lot of talk about AI driving productivity, and the fact is, many small businesses, to Fran's point, aren't seeing those benefits right now. They're stuck in the noise, unclear goals, still digitizing a lot of business practices, traditional limited tech. And one of the things a lot of people aren't talking about, employees feel unprepared and sometimes really fearing what AI really means to them and their future. So PIPIQ, we're changing that. We're giving small businesses a private intelligent platform built for simplicity, security, and real productivity. So we're focusing on the business fundamentals like operations and administration, customer service, communications, reporting, and the things that can really provide those meaningful returns in a fast and productive way for these businesses. And here's the alarming thing, Matt. Nearly 80% of employees are using AI in the workplace, and nearly half of them have admitted, and this was a KPMG study, nearly half of them admitted to copying and pasting sensitive company information into unsecured public chatbots, so like a ChatGPT, like you mentioned. So think about the compliance, the security risk that are being exposed, as we speak right now, to all those business listeners that are tuning into the program right now. So we're tackling that head on with PIPIQ, providing that secure workspace for teams where companies can take their documents, their files, their reports, put that into a secure archive within their own siloed, secure instance. To provide those trustworthy insights, not hallucinations. And then that data itself is protected at every single stage and all within compliance with those critical standards of HIPAA, GDPR, SOC 2 certification. So in a nutshell, we want to provide those small businesses a way to adopt AI that simplifies their operations, provides those returns, and boost productivity for small business America.
Hey, Fran, NFL obviously is not a small business. It's big business in America, but each team surely wants to keep its own data private as well. Have you talked to any NFL franchises that might want to use PIPIQ?
I've talked to some. Of course, I'm close to the people that own the Minnesota Vikings. They're in New York. They're great owners. But we haven't gone there yet. And exposed it to them. We will, because we're out in the marketplace now. We've launched our product about 2 or 3 weeks ago, and we're having great success. And I want to see that success before I go talking to my guys in the NFL.
What about using AI, though, Fran? Do the coaches or the commentators already use AI in the NFL, and can that technology help them?
If they're using it, I'm not aware of it, but I haven't asked either. But I don't think they're using a lot of AI. Big businesses that have billions of dollars to put in the AI, they're the mainstream that's pushing it. I don't think it's gotten down to the NFL or professional basketball or baseball or the small business people, and that's why we're in that marketplace. And we will make the NFL know what we're doing and see how it could help them.
Will, what do you think about a customer base? Who are you aiming this at? Do you have prospects already that you're talking to? And how quickly will they be able to show a return on investment with PIPIQ?
Great question. Yes, we're really focused in that small business vertical. So we believe in that 50 to 250 employee range. If you're looking at it from an employee size. Also looking at industries that are very conscientious around either on the productivity side or on the compliance side. So industries that are going to be, regulated or licensed professionals. So looking at insurance, legal, accounting, things of that nature, where the protection of client data is, of utmost importance and paramount. So looking at it from that nature, in terms of return on investment. Just received a fabulous note yesterday from one of our very first clients, actually, in the senior living space that put this into production. They have about 300 different field representatives that are out in the market servicing their clients, and they put all of their training, programming, all of their best practices, all of their service requirements, all inside of this, inside of PIPIQ. And just in a matter of 3 weeks, they've seen about an 80% reduction in management interventions out in the field, because their field reps are able to go into PIPIQ and get that immediate, best practice driven, one source of truth information to go ahead and intervene in those customer service situations, instead of having to go and ask Tom, ask Mary, what is the best practice in this situation. They can go straight to the source.
Will, great to get some time with you. Will Adams there of Tarkenton, and of course, NFL Hall of Famer Fran Tarkenton. Really appreciate your time. Coming up, Nancy Pelosi is calling it a career after nearly 40 years in Congress. We'll discuss her legacy and what's next for the Democratic Party. This is Bloomberg Open Interest. Nancy Pelosi is ending her nearly 40-year career in Congress. The 85-year-old California Democrat and first woman ever to serve as Speaker of the House says she won't seek re-election next year. Let's get more now from Bloomberg's Washington correspondent Tyler Kendall. And Tyler, what can we say about, such a storied career, and yet she's going to remain in Congress until she's, 87?
Right. She says that she's going to finish out the term, Matt. And of course, this is coming at a time when Democrats are really trying to coalesce around a message going into the midterms. So perhaps that gives us a little bit more insight here into her decision, considering that we know that she has been a force both on the national stage, but also behind the scenes when it comes to the Democratic Party. She led House Democrats for nearly 2 decades. That included 2 separate stretches as Speaker under 4 different presidents. Of course, you mentioned her history, making both as the first woman to hold the Speaker's gavel. And then she made history actually again, becoming the first lawmaker to regain the Speaker's gavel in 50 years, because she had these 2 separate stints with it. Of course, the first one, 2007 to 2011. I was looking up, of course, her signature legislative achievements, including the Affordable Care Act. Now we know that a part of that is currently at the center of the government shutdown. Also, of course, helped shepherd the Dodd-Frank Act in the wake of the 2008 financial crisis. But Matt, we know that part of her latter stint between 2019 and 2023, she was really seen as by her party as a counterweight to President Trump. They had quite a few contentious moments. Of course, the House oversaw 2 impeachment inquiries into him. And then we all remember that viral moment where she ripped up President Trump's State of the Union address in 2020.
Yes, and both have made so much money with political careers. Tyler Kendall there reporting from Washington. Let's get a quick check on the markets as we head to the end of the program. We're looking at losses right now that are accelerating again. S&P 500 down 0.9% at 6736, and the NASDAQ 100 off 1.5% as companies that even beat expectations are disappointing investors. Coming up tomorrow, Rick Reeder of BlackRock and Diane Schwank of KPMG, plus the CEOs of Activate as well as Fubo TV. This is Bloomberg Open Interest.